Hey everybody, I'm Kavan from the CoinFund venture team and really appreciate you all making it out today. We're going to talk about crypto M&A trends over the last 18 months or so. I'll be brief on my background. I work on the venture team at CoinFund. We do seed through early growth investing, and I'll toss it over to these guys to introduce themselves. Evan?
Sure. My name is Evan Kohlman. I'm the CEO of Cloudburst Technologies, which is a CoinFund-backed company. I previously founded another startup known as Flashpoint, which is now a major cyber intelligence provider, and I'm based in New York.
My name is Jeffrey Ugbah. I am the head of U.S. corporate development at a digital asset prime brokerage called FalconX, and I've been there for about 7 months. I was previously at Galaxy Digital on the banking side, and then before that, I was a traditional investment banker covering frontier technologies and gaming.
My name is Pietro Moran. I'm the director of crypto at Shift4 Payments. We're a global payments infrastructure company, public here in the US for 26 years. Previously director of crypto at a company called The Giving Block, which was and is the world's largest crypto donations platform for nonprofits to accept crypto donations.
Yeah, so we've got an awesome panel here, a lot of M&A experience. Jeff, maybe we could start off with your role at FalconX, and you could maybe highlight a recent acquisition that you guys have gone through.
Yeah, for sure. So I mentioned I started about 7 months ago at FalconX for the express purpose of working on a lot of larger scale transformational M&A opportunities. We recently acquired a derivative shop called Arbalos Markets, and so one of our theses is that there's going to be an increasing convergence of different types of services consolidated within a single platform, a la the traditional prime brokerage model. And so we wanted to beef up our talent on the crypto derivative side as well as the option side. And so we hired a very strong team in Arbalos Markets over a pretty long process, and they've been doing quite well in this market especially.
Terrific. And Evan, you have a unique experience with M&A as well. Your previous company, Flashpoint, was acquired. Could you maybe tell us a little bit about that experience?
Sure. We founded Flashpoint back in 2010, and it was my first company. I didn't really think much about the exit path, to be honest with you. When we started off, the idea was to build a company. Nonetheless, about 10 years into it, we started getting interest from potential acquirers. There are a number of different things I learned along the way. Number one, you have to plan well in advance for an exit path. Some people get lucky and they get exit paths that come across their desk randomly, but you should really be thinking about this kind of stuff well into your journey, because of the fact that unless you're planning on going public, the other option is going to be M&A, and you have to be thinking about who would be a potential acquirer and what the dynamics of that would be. Number two, you have to look carefully at what the options are that are in front of you. And what do I mean by that? There are different types of acquirers. My last company was acquired by private equity. That is different than a strategic acquisition. It's different than other types of acquisitions. You have to be very careful with private equity folks. No offense to anyone. This is something you have to think about very carefully, because of the fact that their expectations may not be the same as yours. And if you get acquired by someone that's looking to take your business and is looking to supercharge it, is looking to put money into it, is looking to do something, you have to have a plan for what comes next. A lot of people, they get acquired by folks in private equity, and then they get all this cash and they don't know what to do, right? Part of that is understanding well in advance, if you had money, what could you do with it? And a big part of that is partnerships. Partnerships are one of the hardest things in startups to organize. It's very hard to get going. It's very hard to be successful with. But if and when you get to the point of being acquired by somebody, and if they are interested in flooding your business with cash in order to try to make it something bigger, you have to know what you can do. And part of that is knowing what other potential acquisitions are there out there, and having pre-existing relationships to know what is going to be profitable, what is going to sync well with your current product, et cetera, et cetera. These are all sort of essential things, and you should think about them well in advance.
That's great advice. And Pietro, you were on the other end of the spectrum at the Giving Block, which got acquired by Shift4, which is a public company. Maybe you could take us through that experience?
Yeah, 100%. Jeff and Evan's comments resonate a lot with kind of the experience that I had, which is Giving Block was, I would say, cash flow positive company in crypto, which maybe in and of itself is a bit of an outlier, at least back when we got acquired. But the experience was really interesting because as a strategic, acquisition for Shift4, which is a payments company, donations were an interesting, I would say, lane for them. But then, kind of to what Evan said, the cross and upsell synergies from what we could add value to in Shift4, which didn't have a crypto business or wasn't serving a crypto clientele previously, was actually very illuminating for me because, I thought we were just going to stay in our lane, and then the M&A team said, "Hey, actually, why don't we build and pivot slightly, to create an entirely new, profile of revenue for the business," which I think is something that a lot of people in the crypto space need to consider as they're thinking ahead of what the kind of terminal valuation and or like success criteria is for their business. So we were acquired 3.5 years ago, built a book of business that's now servicing like, on and off ramps, exchanges, and the like globally, which didn't exist previously. And, when we were going into the discussions around M&A, like, I would say it was a known unknown. It was like, we can try this, but then when you apply the scale of a large public institution to, just the tech that we had kind of built and the know-how and acumen that we had, it worked out quite well. So it's been really great. And Shift4 is a very acquisitive company. I would say in the payment space, we're probably in the top 5 most like acquisition hungry companies. So we buy a lot. That is like our growth strategy, and the street respects our intelligent use of capital. Thankfully, the bet that Shift4 took in crypto was a success, or at least I like to think it was. So we can keep trying to do more of that because, at least for payments, the intersection of stablecoins and this trend that we've probably all been watching unfold for the last 18 months really aggressively, but really since anybody who's thought about stablecoins and their potential like maybe had the intuition to see. I think that's really been heating up, and I'm sure in your business you've seen comps and everything start to re-rate, so it's a very hot sector for once. 3.5 years ago, we felt like we caught the last boat before the bear market, but it's nice to see the pendulum swing back.
Maybe I can add to that.
Please.
So I've seen it on both sides, on the corporate development side as well as on the sell side, so the buy side and the sell side. And one of the things that I've noticed is that revenue synergies are extremely hard to calculate prior to the actual acquisition signing, acquisition closing. And the more work that you can do upfront, obviously as the buyer, but in addition as the seller, to try to crystallize what those revenue synergies could look like, the higher the potential purchase price could be for your business. And it's an old adage that I'm always familiar with from my old banking days, is that 70 to 80% of M&A transactions end up being economic failures. And part of the reason why is because that synergy realization is not actually fulfilled because there's so much friction in combining two companies and trying to figure out cultures and not really doing sufficient diligence prior to entering into that kind of merger or that acquisition in the first place. And so I think getting the synergy part right up front sets you up with an excellent foundation to be able to build a lot of equity value for your organization, the combined organization in the future.
That's an awesome point, Jeff.
I've heard like 3 times from people saying, "Oh, this is going to be so easy. We're going to be able to merge these people in within a year, no problem." And then 6 years down the line, it's still a catastrophe. So, I actually have rarely ever seen anything done successfully. Usually, it's all so. If you're planning on this, assume it's going to take twice as long as you think, and it's going to be twice as hard, and things you never counted on are going to come up along the way.
Awesome. And so the last 18 months have been a tremendous time in crypto M&A. Before July 2024, we had no acquisitions over 600 million. And now there's been 10 billion over the last 18 months. I'm curious what you guys think changed in the market that enabled this huge uptick in M&A. And maybe we can start with you, Pietro.
What do I think changed? I mean, I think people finally, at least from my point of view, I think people finally understood how to take and monetize the trends and the technology within crypto that we've known about maybe for a cycle and a half. It wasn't very hard to predict that stablecoins were going to be transformative. I think it was very difficult to realize what the business model would actually be to then generate these outcomes for M&A, for exits, for real revenue recognition. If you think, and I'll speak just about Shift4, right? The discipline on the revenue side and the operational side of the business that being part of a large public company actually forces on you as a startup that can be a little more fast and loose is pretty significant, and those expectations are real. I think that it's really a part, it's partially the industry growing up. I think we all kind of took our licks in the last bear market and said we're going to build, and we're going to build things that actually generate revenue, which ultimately is the arbiter for a lot of success in many of these outcomes, or at least gets you on the radar for potential acquisition. I think the other component is that we had a different regulatory regime. I think that is, paramount. I mean, I think even the traditional IPO window, you look at things like just the full cycle of, the capital markets was not really converting. And so now that some of that liquidity is turning over, we're seeing more interest from traditional markets. And I think inside the crypto markets, we're seeing a lot of consolidation because now the board is set to figure out who the players will be for the next decade, 2 decades, et cetera. And I'm sure you have a ton of these. We were talking at dinner last night about Deribit acquisition from Coinbase. I mean, a lot of the stuff that's going on right now is just who is trying to get the right puzzle pieces that are maybe somewhat undervalued because they're startups or didn't get respected last market. And now we have the chance to intelligently allocate capital and actually reap the benefit. I think there's a lot of companies that saw crypto as a very high potential industry, but the businesses weren't mature enough to buy, or at least not exciting enough to buy because $5 million ARR company is great, but that doesn't get a large public company who's trying to move the needle on a multi-billion-dollar equity or market cap to jump in necessarily.
And maybe I totally agree with that. And maybe I'll jump in with a couple of other points. So on one hand, I think that there is a huge FOMO effect as well, right? And there's a recognition that you need to be able to do at least one of 3 things: acquire licenses, acquire distribution, or acquire rails. And if you're able to do that, you can compress massively the amount of time it takes for you to get to market across various subsectors within crypto. So that's kind of one thing that a lot of folks were feeling the pressure from a lack of premium assets. And so there's asset scarcity of top tier quality businesses that are out there in crypto that have achieved the license stack, achieved the tech stack, the distribution stack, the user base that would generate meaningful revenue in the long term. Another kind of boring factor is specific kind of accounting changes that have happened. So for example, I think there's SAB 121 made it such that you no longer had to mark to market to the downside your crypto. And so before, I think what ended up happening was if you had crypto on your balance sheet and those tokens depreciated in price, you had to reflect that on your financial statements, but you didn't reflect the symmetrical appreciation on the flip side. So it was an asymmetrical negative impact having any type of token or crypto asset on your balance sheet. That's changed so that you are reaping the benefit in both directions. So if there is price depreciation, that's reflected on a mark-to-market basis. If there is price appreciation, that's also reflected. And so there's less of a negative impetus, and is actually encouraging more chief strategy officers, more chief financial officers to consider M&A transactions because there's less of a negative yo-yo effect on your balance sheet. There's still a yo-yo effect, but it's not as pronounced to the downside.
I mean, things have matured a lot in the last few years. I remember going to EthCC back in 2023, along with DeFi Security Summit. And if you compare it to this year, 2 years ago, it really kind of felt like a Star Wars convention. I think there's been obviously some significant changes in the political and regulatory environment, both here in the United States as well as in Europe. Different things have happened, but the bottom line is that I think some of this stuff has become more mainstream. Investors are more willing to put money into it. I remember when I was raising my seed round back, now 3 years ago, and people look at me like I was nuts. So things have changed a lot. I think it's become much more mainstream. There are more profitable applications. It's much easier to get investors, mainstream investors, to take you seriously as well as potential customers.
So far the market's been dominated by payments and trading / infra related M&A. Is that a trend you guys expect to continue? Maybe Jeff, you can kick it off.
I think so, and the reason why is because you see immediate scale on the distribution side. Obviously, you see more immediate revenues, and I think that there is a wariness now from the previous cycle in just buying pure play excellent technology, right? There was a sentiment back in 2019 to 2022, let's say, that if you build it, they will come. As in, if you build it, the developers will come, or the end customers, either institutional or retail, will come. I think what's proven out is that that's not actually the case. And so I think the focus going forward is going to be on, are you generating real revenue? Are you burning cash? Are you a real business that has cross-cycle resiliency? And so, yeah, everyone potentially can do very well in a bull market, but how do you stand? What is your performance during a bear market that is really kind of the test of, hey, the emperor's wearing no clothes, or hey, this business is extraordinarily robust and durable despite what the current crypto or macro market conditions are today?
That's terrific. Pietro, do you have something to add?
I mean, I'm going to talk my own book here because I work in the payment space, right? But I think it is a trend that will continue. I mean, historically, a lot of crypto revenue is like extremely pro-cyclical, right? You'll go and have a 500x year in terms of, year-over-year growth, and then you'll go down 90%. And you see that in the on-ramping space. You see that in the exchange space historically. You see it in, a lot of trading infrastructure or related products, I would say, because everybody rushes in during a bull market and they want access to these products and services. Retail is coming back in, and they're generating a lot of the revenue if you're on the trading side or the on-ramping side. I think now we have a little bit more of and I think you hit the nail on the head, Jeff. It's like a more resilient revenue profile of an industry where it's not like, hey, we're buying something and maybe we get a 2x next year, but then it goes down 80%. And we still have to justify spending money. And if we're talking about M&A specifically, I think it's a trend that will continue because I think we need to bifurcate the market where, like, you work on the VC side. On the private side, you set the market, you set the price. And I think we're finally starting to work more in lockstep where now the actual natural acquirers of these companies are starting to understand maybe the underwriting and like validate the underwriting that you do. Whereas historically, I'd say private markets were overvalued, and then you try to sell that company to a strategic or have an exit, and they're like, well, we can't justify that price tag. And I think now it's like, okay, maybe we're a little less starry-eyed and we're more rational on the valuation side to begin with so that you can have these exits. So to actually answer the question, I think infrastructure payments definitely going to be a major trend because a lot of these crypto companies are form-fitted from a tech and talent density standpoint to fit into like payments companies. We have the distribution. Our moat is the customers that we already have. It's such a steep hill to climb to go and try to sell payments or crypto native payments to the whole market all over again. Like, might as well kind of just take the exit route because you can apply that and recognize your vision as a company faster.
That's terrific. Evan, anything down on your side?
No, I mean, I just think infrastructure and security are just sort of two obvious areas where there hasn't been a lot of investment. Historically, security, very little. And now those areas are ripe for development, especially because many of these things are profitable.
Absolutely.
Maybe I would love to understand from your perspective, working with PE, is there a play when it comes to rolling up a lot of on-chain analytics, blockchain analytics, KYC, AML companies into a very powerful risk tech platform?
Yeah, I mean, definitely, because right now the market is very bifurcated, and you have some different small players that are running around, and I think some of these folks are finding it difficult to make enough money on their own. So I think it sort of makes sense that you take one, two, or three of them, kind of package them up into something that, yeah, I mean, absolutely. I mean, we see that, like my company, we focus on off-chain intelligence. And we work with on-chain intelligence companies like Chainalysis, TRM Labs, and others. And we frequently get questions from prospective customers. Can I just buy all this together as one product? Why does it have to be sold as two separate products, even as a partnership? This just would make sense all as one product. We love to hear that because then I go to these other companies. I'm like, hey, you guys want to buy us? But yeah, I mean, it makes a lot of sense, and we've seen the same sort of trend also in sort of cyber intelligence and cybersecurity more broadly, where you've seen PE come in and try to wrap up a bunch of different players and kind of fit everything into one thing to make it much more profitable. Yeah.
That was a great call, Jeff. I don't know if people have seen Inversion Capital, but they're trying to bring PE rollups on chain. And there's a couple other products that are doing that in stealth now that will come out soon.
Had no idea.
I'll send it to you after this. But so, obviously payments and infra M&A makes a lot of sense. What are some sectors in crypto you think we could see M&A start to pick up? And maybe I'll go first. I think gaming is like really ripe for that. A lot of the gaming tokens are trading like in the gutters right now. And that was something that is actually had the most capital invested in crypto since I've been in the space in 2022. But I'm curious what's top of mind for you guys.
Yeah, I'll start. I used to be a gaming banker. My perspective may diverge on the gaming piece, but I won't touch on that. So I think credit intermediation could be really interesting, and the model that traditionally was the focus in TradFi was, hey, we want trading execution services, we want clearing, we want custody, we want credit and financing services. We want to be able to do this from one venue, and then not have to worry about having to collateralize different accounts across different businesses. I think in this case, when it comes to crypto, I think there's the same impetus to have a full institutional stack of services that cuts across trading execution, derivatives, options, but also credit, which I think is a good potential synthesis or convergence between crypto and TradFi on the private credit side, where they're looking for a lot of opportunities, and they've also raised a ton of capital on that front.
So I totally agree on that example. I think we can't let the crowd not hear your take on M&A and gaming. If you wouldn't mind, just like maybe 2 sentences.
So I'm a lifelong gamer, and I think I've always been long-term bullish on blockchain and crypto gaming, short and medium-term bearish. And the reason why is because there's the same bifurcation when it comes to who is actually the end player or the end customer or the end retail party, right? You have the players of the game that are doing it for community or for status or to just have fun. And then you have the more, let's say, economic animals who are there to extract as much value from a specific ecosystem in gaming as possible, and then move on to the next. What ends up happening is that very small party, in most cases, significantly degrades the experience of everybody else to the point that nobody wants to play the game, right?
That's a great point.
So that, for me, whenever I see a Web3 or blockchain or crypto gaming opportunity, the first question that I ask is, okay, is the game actually fun by itself? Does it need any of these blockchain or Web3 capabilities, or is that the main draw? And then the game piece of it is an afterthought.
Terrific. Evan, what about you? And you can't say security.
I was just going to say security. I would just first of all echo that, which is that the things that are going to make money are the things that are not gimmicks, where it's not like I'm just slapping on blockchain technology onto this or that, where it's a genuine use. And again, I do have a very narrow perspective here, but and forgive me for this, but yeah, I mean, security is a look. FTX didn't invest any money at all into cybersecurity or into any security at all, or really compliance either. And if you talk with any of the exchanges or the stablecoin issuers, you'll see that there's been a huge sea change in terms of their perspective over the last year or so. They went from being very, very very pro-risk and very willing to go very far out in a limb to where all of a sudden now issues like compliance, regulation, et cetera, these are becoming very, very serious issues for them. You can argue about why it happened. Obviously, the CEO of Binance going to jail is one possible incentive. But we are starting to see where, some of the stablecoin issuers that were like literally 2 years ago, if you told them, hey, listen, your system is beset by money laundering and terrorist financing and everything else like that, they would have tried looking in the other direction and running away from you, like on TV, like a TV show. They would have like literally tried running away from you. Whereas now, all of a sudden, these issues are something that I think they realize they can't run away from. And then on the other side of it, if you look at the big players in the market, most of the security players in the market, most of them, when it comes to Web3 and crypto, basically what they are blockchain tracing companies, right? And number one, that's not really a solution. That's more like consulting work. Number two, it's not really scalable. Number three, there's only so much that block tracing can really tell you about what's gone on in terms of an illicit transaction or whatnot, and it doesn't do it in real time, which means that if someone is trying to go through live transactions at a very high rate and determine is this person possibly in a sanctioned region, is this person possibly trying to break into my system, there's just not enough time to be doing those kind of things. So there's a lot of room right there for, I think, for development in that area. And because of the amount of money that's flowing in the market, I've been saying this for a long time. People sometimes stress about the cost of security or the cost of compliance and whatnot. What people have to put into perspective is that there's a massive, massive number of people that are not currently bought into crypto or Web3. And many of those people, if not most of them, the reason is because of the fact that there are not the traditional kind of protections associated with normal banking that apply to crypto. And if you can bring that sense of security and stability to the market, there's a huge number of customers that are just waiting out there to dive into the market. So this is like, yeah, there's a cost associated with it, but it's also like that's the key to unlocking this market. And I think a lot of the key players here, the stablecoin issuers, the exchanges, they have either realized this or they're on the precipice of making that recognition. So, like I said, that's why infrastructure and security is just a good market right now.
Terrific. Pietro, do you have a dark horse M&A sector?
So if I want to be optimistic, I think it's challenging because I think a lot of crypto native companies, especially ones that issue a token, have a natural barrier to M&A on the basis of competing against other peer group, like others in their peer group, with this sort of pseudo equity offering that's already live in the market. And I think anybody who's been in the space long enough understands it's like very hard to deprecate a token or change your token or roll up into some other organization. I would say though, like once we cross that Rubicon and somebody figures out a model that actually works, I could see like DeFi that's fitting into some sort of like a regulated sleeve of a traditional banking offering being very exciting for folks to go and grab those assets or that on-chain infra or tech stack or smart contract stack that could then apply within the, again, like the same distribution economics of say like buying a stablecoin related payments company and applying it to hundreds of thousands of customers. Do the same thing for banking, I think would be my dark horse, but I think the hill's a little steep to climb just because of the tokens already out there living and it's hard to do M&A around that.
Yeah, that's a great segue to our final question, which is a little bit divisive in the investment community, which is if you have a listed token, can you be acquired by a public company for your equity? And I'd love to get Jeff and Evan, your guys' thoughts on that.
I think it's very challenging unless it's properly structured. And I think part of the reason why is that touching anything that has an impact on retail investors is automatically going to get you within the targeting reticule of FINRA and the SEC, right? And so the structuring component needs to think through, okay, the foundation or the DAO is one entity that at best we would have an arm's length relationship. What we're really trying to acquire is let's call it the DevCo, right? The development company, the team, some of the tech that's not open source, figuring out what is and isn't open source is going to be a big question. Some of the service contracts or some of the existing commercial agreements that the DevCo has with, X foundation entities is going to be really important. And then establishing or understanding what is the long-term contractual relationship between the DevCo and the foundation, right? Because that's going to drive a lot of the revenue generation and a lot of the equity and enterprise value for the company in the first place. So unless that distinction is made, and there's a lot of different distinctions to get to that point, I think it actually is very, very challenging. But if you're able to do that, you can slowly accrete more value from the token ecosystem. Maybe there's some type of structure where you're saying, all right, over the course of, X number of years, if there are these types of technology developments and we hit our milestones, there's an earnout that's reflected in a larger chunk of unlock for vested tokens, right? So that could be a structure. I think at the end of the day, the best thing to do would be to avoid ever demonstrating ownership and control of the ecosystem, the governance of the ecosystem, and the kind of the overall market of that particular token.
Awesome. Evan, anything to add?
I was talking with a colleague at ECC a few months ago, and he's affiliated with Ton Coin, and he was complaining bitterly that he had just been debanked by a European financial institution just on the basis of the fact that he worked for Ton. So, the reality is that I've spoken with any number of VCs over the last 3 years who, the moment you mention anything about tokens or about anything like that, they run. The only people that are cool with that are really crypto native VCs like CoinFund. I think, because a couple of different times people had asked me, why don't you guys issue a token sort of like, or do something like Arkham or whatnot? And the reason is because of the fact that dealing with anyone in TradFi at that point becomes just absolutely impossible. It just becomes incredibly impossible. And for anyone here who has had to try to apply for permission to hold a wallet in like Coinbase, for instance, my company, Cloudburst, is a Coinbase Ventures portfolio company, and I can tell you flat out that, and we work with U.S. government agencies and whatnot, we were not able to pass the compliance process to get a corporate account on Coinbase for our company. So I think the reality is that public companies, anything TradFi, are very, at this point, anything tokenized, they are very reluctant to touch unless you're coming across people that are very forward thinking, that have a background in crypto, have some knowledge in crypto. I think it'd be a hard sell.
Yeah, at CoinFund, we definitely believe it's the entrepreneur's decision. If you're going to accrue value to the token or to the equity, it's your choice. I'm personally of the mind you only have one to pick from today, but I'm excited for the day that someone proved me wrong. Thank you guys so much for the time, and I really appreciate you all flying out for this panel.
Thank you.
Thank you.